Welcome back. Earlier today, the Census Bureau reported wholesale inventories remained on a month-over-month basis pretty much unchanged. We're going to take a look at the different sectors within the wholesale inventories number because it actually gives us a great deal of insight into the U.S. economy. What it does is it measures the change in the total value of goods held by inventory by wholesalers. Now, the inventory is reported in millions of dollars. High and low inventory reflects exactly the amount of demand. When there's less demand, when the economy is weak, inventories go up. So a high number is actually a bad number. When inventory is low, it means there's more demand on the retail level, and that means this economy is stronger. And this goes directly to determine what the GDP, gross domestic product, is. Here's wholesale inventories in terms of durable goods. Durable goods are those products that are meant to last more than 5 years, such as washing machines, appliances, things of that nature, automobiles, aircrafts. Durable goods in red in terms of the wholesale inventories. The white line is the S&P 500, and we can see a negative correlation. You're going to see this throughout the different charts. When the stock market goes up, as it did late 2021, 22, we saw inventories were low. However, when the economy started to falter, at least in terms of the stock market, inventories are rising. Inventories again rising because there's less demand for those products. Here's wholesale inventories in terms of petroleum products. And we can see petroleum products hit a pretty significant high as the stock market sold off, hitting lows around October of last year. Motor vehicle parts, near all-time highs, at least as far back as our data suggests over here. There's really not a lot of demand for motor vehicle parts and supplies, at least as of late. Farm products, a different situation. It's probably one of the better performing sectors within wholesale inventories. Not a lot of inventory out there for farm products. Alcohol consumption, including beer, wine, distilled products, there's a lot of inventory out there, and this goes to reflect maybe the state of the economy. Here's the wholesale inventory in terms of apparel, coming off its highs, but still significantly higher than it was 2021. There has definitely been a slowdown in the demand for apparel. Computer products, the demand has picked up. Wholesale inventories for computer equipment and software is down low, and compare this to the stocks that we watch also in our portfolio and otherwise. I think you'll notice strong correlations when there's greater demand for computer products. A lot of tech stocks have been very, very strong lately. The NASDAQ has been outperforming the Dow Jones Industrial Average and the S&P 500. Maybe this is also reflected in a greater amount of demand for computer products, and as a result, low inventories. Here's metals and minerals. Wholesale inventories near the lows. Metals have been stronger, especially in light of a weak dollar, as of late. Here's wholesale inventories in terms of machinery, equipment, and supplies. Really, pretty much very significant highs that we've seen, and I think this goes to speak to a slowdown in the manufacturing that we've seen, as of late. Here's wholesale inventories in terms of lumber. I would guess that this probably has a closer correlation to the home builder stocks in the housing market overall. When we see wholesale inventories drop, now this is different than the inventory within the housing market because that's much more interest rate sensitive. That affects not only the buyers but also the sellers. But we see here inventories, wholesale inventories have come down. Now there's less inventory, maybe there's a greater amount of demand, but there are other factors that go to affect the housing market. These high interest rates, we're going to talk about this in the time to come, about the lock-in effect where the high interest rates are really locking in sellers, where sellers may not want to sell because they would have to take on, a new high interest rate mortgage. But that's a discussion for another day. Here's wholesale inventories in terms of chemicals, coming off its highs, but still quite strong. Here's wholesale inventories overall over the past year or so, more than a year, different sectors. Now, the red dotted line are the durable goods. That's the overall number that we follow. We see what has been the weakest, and again, weak is actually good. because when inventories are down, it means there's more demand. There's been more demand for farm products and raw materials. That's this yellow line at the bottom. That's followed by petroleum products. Behind that, apparel. Behind that, the green line is lumber and construction. Those numbers with the highest amount of inventories, machinery by far. Machinery also, we see metals and minerals is quite high. And the white line, motor vehicle parts. I would say motor vehicle parts and machinery are probably the weaker sectors of our wholesale inventory. And then finally, we take a look at the monthly change. This is a month over month basis. Now, of course, this number is also repeated 2 months behind. So this is not reflecting necessarily what we see right now, but rather the overall trend. The biggest move down since the last report has been farm products, a real drop in inventories. Maybe in light of the higher prices at the supermarket, there's been a greater demand for farm products, and as a result, lower inventories. So the farm products, we've had the big drop. Petroleum products as well, lower inventories. The biggest increase, metals and minerals, also machinery and equipment, also chemicals and motor vehicle parts. Motor vehicle parts, machinery, equipment, I think are probably the two weaker spots of our overall wholesale inventories. So it gives us a very interesting insight into the economy as far as where the inventories are, where the demand is, and where's the lack of demand. And we're going to watch this number pretty closely in the months to come, because it's going to be very interesting to see how this develops, especially in light of very likely more interest rate hikes, which we could see in the near term future. We hope this has been helpful. We look forward to seeing you back soon.